Over the last 2 months, it's been very fair to say that Chegg stock has been completely abysmal for shareholders. It started in early November when the stock dropped almost 50%. Now, I used to own Chegg, but I sold it to help buy an Apple share. Looking back at it, it has definitely paid off for me. So when I saw this news come out, I was completely shocked. So in today's video, we'll be going over my thoughts on the entire Chegg situation. We'll be going over a CEO interview and some other news, basically why the stock dropped. Now guys, it is New Year, and I would appreciate if you're new here and you do enjoy the video, make sure to smash the like button, subscribe. My goal by the end of 2022 is to hit 150 subscribers. We are currently at 49, so if you want to be the 50th subscriber, make sure to subscribe right now. Also join the Discord link in description, and roll the intro.
Hello, I like money.
To start off, we'll be talking about why the stock actually dropped. First, their subscriber count dropped from 6.4 million to 4.4 million, aka they dropped by 2 million. Chegg's CEO also mentioned they were dealing with a lot of labor issues along with COVID-19 issues as well. They also had a really bad earnings report. Top that, student enrollment to colleges is at an all-time low right now. This is obviously a huge blow to Chegg's business, as they do rely on college students for most of their income. So all this news caused fear in investors, and the stock dropped 50%. Personally, I think 50% is a little bit of an overreaction, but I think a big correction was needed with the stock. Chegg said that the decline in student enrollments would take a toll on its fourth quarter results. Management now expects the company to generate sales of 194 million to 196 million, which was well below Wall Street estimates of 241 million. Along with that, analysts are also cutting their price targets from the low 100s and maybe high 90s, 80s to now the 50s. So obviously here what we're seeing is a huge fundamental change and an unexpected change in Chegg's business. And I almost do kind of feel bad for them too, because it's not like they can control, student enrollments and COVID and labor issues as well. So I do honestly feel bad for them. But hey, to give some good news to Diamond Hand Chegg owners right now, the revenue year over year grew 12% to $171.9 million, driven by a 23% rise in their services revenue to $146.8 million. Along with that, their EBITDA jumped 45% to $46.4 million. Now, Chegg's CEO Dan Rosenwig, I probably said that wrong, he said this: a combination of variance, increased employment opportunities, and compensation, along with fatigue, have all led to significantly fewer enrollments than expected this semester. So clearly they were not expecting all of this, leading to them to majorly miss their goals this quarter. Now here's an interview with the CEO of Chegg, Dan Rosenwig. And this was done on CNBC.
And bad, tough day for you, Dan. Just explain why everyone was so caught off guard by what's happening in the business right now.
Yeah, a couple of things. First of all, I think you can tell from the reaction of the stock that it's significantly overblown. It's sort of absolutely surprising. Not that it went down, but that just at the level and the volume, because we feel very confident about the future of the company, where we're going, the opportunity, the international growth. But what caught us off guard, and therefore everybody else, was the fact that much like young people going back to the office, they just don't want to go. College enrollment is substantially down. It's been down 3 years in a row. Normally during a recession, it goes up, which was last year, but because of COVID, it didn't. So it went down. International students didn't come. This year, because the economy is so strong, that ambitious students, like the ones that use Chegg, they chose not to go back to school. They chose to go work because the salaries are so high. They also have children, so we have child care issues because 60-some-odd% of all college students are women. The average age is actually 25 years old. So we serve a lot of people that are balancing family, workplace, and school at the same time. And community colleges just literally, feel like they're empty in terms of people making different choices this semester. Add fatigue to that, which is even those students that chose to go back are taking nearly 10% fewer classes per student. 16% of students are taking more pass-fail than they have in the past. And it was just a whole bunch of things that we didn't anticipate because we were doing phenomenally well the whole year, July, August, even the beginning of September. Somewhere around mid-September when it normally picks up, it just didn't. And so enrollment and fatigue and people taking jobs where they can get paid a lot more money than they historically have been paid. And along with the fact that we can see from the usage of Chegg that professors are assigning less right now, and maybe they have fatigue.
To be honest, I think Rosenwing handled this interview very well. I think he was also really realistic with what he said, but he still showed good optimism. Now let's move on to my thoughts about Chegg. Alright, so I am quite a bit concerned. This isn't necessarily related to Chegg, but with college enrollment. Like, this doesn't have anything to do with their fundamental business. Obviously, it will impact them, but I personally think that college enrollment will go lower or will decline in the future. I personally think that, college, I think younger people are starting to realize that you don't have to go to college to be successful. There's going to be more entrepreneurs, and I think it's a pretty general topic with entrepreneurs. They don't usually go to college, they're going to work on their business. And I think there's also, more companies are paying higher, you can make more money not going to college and not getting in all that debt than, going to college, picking up that debt, still getting a degree, and then, having to pay off that debt in the early years in your 20s. So that's my overall 2 cents on, college enrollment. So obviously I think that's going to impact them negatively in the future. And I think that this overall, big dip here is just a really big correction. Obviously their future is nowhere near, the same as it was a couple of months ago. But I think that they can still do decent as a company in the future. And I'm, actually a little bit confident that they will be able to, post good returns if you buy now. Obviously don't take that as advice, do your own research, yada, yada, yada. But, I think if you invest now, there's still a chance that you can actually make good returns long term with this stock. I'm obviously not going to be buying any because if you know me, I love my dividends and I'm a dividend growth investor. I'm not really looking to add any new positions unless they're a super high quality company. I am not bullish and I'm not bearish on this company. I'm somewhere in the middle. Right in the middle of bullish and bearish. I don't think this stock is going to go up 100%, but I think it could be a pretty steady investment. So those are my 2 cents. Guys, I upload every Saturday at 3 o'clock Eastern time, or at least around there. Make sure to like, subscribe. It would mean a lot to me. Please do it if you did enjoy the video. Make sure to, lastly, of course, do dividend stocks, not drugs. Have a good one.